Hello, clients and friends of MBP Sterling Partners. It's Jamie. I'm broadcasting to you from our virtual AI created office, and I'm here with a Q4 2025 outlook. Hopefully, you've just watched our recap of 2024 year to date. If you haven't, it's the video immediately preceding this in your video feed. So let's get into it. So let's get going here. What are we going to look at today? Well, we're going to look at our market themes. We're going to look at interest rates, and we're going to have a discussion about market enthusiasm. So what about our themes for 2025? Well, we talked about policy volatility. We think we've seen that in spades. We talked about higher interest rates. We got that partly wrong, partly right. The short end of the curve is lower, but the long end of the curve has stayed a little bit higher this year, and a much steeper yield curve has resulted. Tariffs, immigration, and fiscal deregulation, I think check, check, and check for all of those. Although the tariffs, we can't call them done just quite yet as they're being tested in court. Read back to policy volatility, the first checkpoint, and we think this feeds back into there. Country focus, will the U.S. continue to dominate the world markets? Well, jury's still out. It's been a big back and forth ride for the U.S. this year. Foreign markets are beating the U.S. year to date, but the year's not over yet, and there has been a lot of wild rides both up and down. And on our investment themes, we won't go through them one by one, but safe to say we think we got some of them right. The hydrocarbon-based energy one we got way wrong. Seems like the world has too much oil, and the prices of such have dropped accordingly. So let's talk about rate expectations. We had both central banks cutting this year. Most recently, the Bank of Canada and the Fed cut on the same day. The Fed's outlook is for a couple more cuts from where we are here at 375. That should bring us into the low threes, which is anticipated to come this year. But apparently the Bank of Canada is done. Tiff Macklem has said they're done. The futures market believes that they're done. Will be data dependent. This futures market is rarely right, so we know that there's going to be adjustments coming later depending on which way the economic data goes. Well, what about this enthusiasm in the market? To say it's enthusiastic is a bit of an understatement, but really that's for certain sectors in particular. The rest of the market we see as healthy, but certainly not enthusiastic. This is the Goldman Sachs index basket. The top returning sectors are non-profitable technology, high beta momentum long, and high retail sentiment. So obviously those are sectors that benefit from investor enthusiasm, whereas the losing sectors of oil input cost, high floating rate debt, and low profitability small cap, they are not in investors' eyes, and there's certainly no enthusiasm there, but we can't actually correlate their inputs to why they are losing. The small cap factor this year and in many years recently has been very difficult, and small cap stocks continue to struggle. So that's why we think those land in the bottom sector there. Markets don't move down just because they've moved up, but over periods of time, we've noticed that when trailing returns start to get very high, that usually a correction is overdue. And this is part of the mean reversion mentality of markets. And what we're seeing now is a trailing 3-year return that is starting to look a little rich compared to history. Last time we were at stages like this was 2021. And of course, we then got the 2022 bear market. We saw this in 2011-12, coming off of the 2009 wreck, and it wasn't so enthusiastic after that. There was quite a big pause in the markets until we got into 2014-15. But then, of course, before that, we had the precursors to the 08 bear market and the 2000 bear market. We wouldn't call these as extreme as that is now, but the mean reversion factor is real. And so, as you may have heard us say before, we are concerned that we are later cycle and we have moved to be more defensive accordingly. So the question is, why is sentiment so bad in the market? Well, markets are pushing to new highs or very near all-time highs at the very least. The market sentiment, as measured by virtually any sentiment indicator you want to look at, is terrible. So rising markets just don't make people as happy as they used to be. So we're looking at figuring out why that is the case. I don't think there's any one single right answer, but we can see historically that previous instances of sentiment dropping, which is the gray line here, the University of Michigan Sentiment Index, has come along with very weak returns. So these are the forward 2-year returns at those times. So you can see every time that sentiment has dropped, it's been as a result of investment returns that have been lackluster. Now we're seeing a similar drop in sentiment, but investment returns are great. So why now? Is it political? Is it economic? Is the stock market dislocated from economic reality? I think there's a little bit of everything in those answers, but we are looking into why, and the answer to that is so far unknown, but we're cautious as we're worried that eventually the market may catch up with this sentiment. Could it be inflation and debasement that are contributing to the poor sentiment out there? Well, it's possible. We know the world hates inflation. We always complain about prices rising, and we had gotten used to a 0 to 2% inflationary world when rates were at zero and when the world truly was deflationary. Following the 2021 and 2022 inflation spike, we believe we've settled into a new inflation world of 2 to 4%. We are certainly not going back to prices that we got used to paying before the pandemic. So that could be leading towards negative sentiment. That said, a little bit of inflation is really good for stocks. And where does inflation come from? Well, it comes from both fiscal policy and monetary policy. As far as fiscal's going, the US and Canada continue to be very spendy. So as you can see here, the quarterly budget deficits for both countries continue to drag that 10-year moving average in the orange line downwards. We haven't seen a budget surplus for quite some time, and the ones in Canada really are structural and have to do with the timing of flows. So the big beautiful bill did not decrease spending like anyone expected it to, and certainly the most recently released Liberal budget in Canada contemplates a record amount of deficit spending. So again, those are good for stocks to a certain degree, and inflation is good for stocks to a certain degree, but clearly this hasn't been good for sentiment. So our big question now is this a bubble? We've heard it over and over. We've had regular client conversations and industry conversations about how this is a crazy market and it's going to end badly. But we want to take a objective look and look at the arguments that might support or counter the bubble argument. So in the support column, we've got pretty extreme valuations. I wouldn't say they are historically at their highs, but they are high compared to any history that we look at. With price earnings ratios and cyclically adjusted price earnings ratios, market cap to GDP ratio, which is also called the Warren Buffett indicator. All these things are pointing to the high side of valuations. Market concentration. This has been a regular theme of this podcast, this discussion. The Magnificent 10, now 10 big companies in the S&P 500 are now account for more than 40% of the S&P's market cap. The breadth in the market is very poor, and previous instances of this type of concentration in any index, let alone the world's biggest index by market cap, has usually led to a correction the other way. We're seeing some speculative investor behavior. Margin debt is high, put call ratios are low, but overall, I'd say these indicators are probably some of the weakest to support the bubble argument. With Canada specifically, systemic risk in housing has always been a concern of ours. The household debt to income ratio in Canada is very high. It's not getting any lower. And the mortgage renewal wall, we are in the midst of it now. We're just at the cliff of a huge amount of Canadian mortgages. It's estimated to be about 50% of Canadian mortgages will reset between Q4 of this year and the end of Q2 of 2026. So those resets, of course, are coming from extraordinarily low mortgage rates. Some of you might remember getting mortgages in the ones back in 2021. Of course, now we're resetting into a high 3 or low 4% mortgage world. So that's going to put strain on Canadian households. And then, of course, there's anecdotal warnings from market leaders. David Solomon at Goldman Sachs, Ted Pick at Morgan Stanley, they have come out and said they see signs of speculation and speculative excess in the markets. So to look at some pictures here to support the bubble argument, We've got price earnings ratios currently in the on the top left chart with the purple X and the ranges, historical ranges of those price earnings. So you can see that international developed in the US are at their extreme ranges, whereas the rest of the world isn't so bad. Emerging markets are pretty hard. They're so cyclical that they're really hard to follow on a price earnings ratio, much like cyclical companies like resource companies, oil and gas, and so forth. The S&P 500 price earnings ratio is in that middle top chart. You can see it is towards its high end, so this is becoming concerning. But we do look at the growth, and is the growth of earnings supportive of a high PE ratio? And also the other thing to think about is, are PE ratios of the past really comparable to the future? The companies that are the biggest part of the S&P 500 now are very different from those even 10 years ago, let alone 40 years ago. And perhaps they deserve a higher PE ratio because they are lighter on assets, they're more productive, they operate with fewer expenses, and generate more revenues and more profits per unit of input. Of course, the concentration in the S&P 500, we talked about that ad nauseum, so we won't get too much more into that. And then the market breadth in the bottom right here, this has generally indicated a more fragile market when market breadth drops. So you can see that breadth is dropping pretty sharply right now, meaning that fewer and fewer companies are responsible for the rally. Lastly, we threw up here the planned spending on artificial intelligence. Just between these six companies, there's $330 billion of planned capex on AI alone. That's more than the GDP of two-thirds of the countries in the world. It is an enormous amount of money driven by a very small number of companies. And as easily as that has turned on, it could turn off. We do not know what will happen if that money stops being spent. We know the first order effects, of course, are that that's being spent on companies that are delivering AI hardware and AI solutions. So those would be at risk should that spending stop. But those companies can afford it. So for the moment, we're not seeing these numbers as being bubbly or debt fueled. So, but we are paying attention because that's just a huge amount of money. And should that money stop being flowed around or spent, it could have implications beyond their own sector. Countering the bubble argument, we've got plenty of reasons not to think this is a bubble. As far as valuations and other metrics are concerned, this is not 2000. 2000 was definitely a bubble. There are several of us that were around trading that market, and the speculative excess there, to be honest, just doesn't even compare to what we're seeing today. Earnings growth is strong of the companies that are participating in this rally and driving it forward. Cash flows are strong. Price earnings ratios aren't even close to what they were in 2000. We're not seeing any new metrics being created by analysts like price to click or price to web page visit, just silly non-economic indicators to try to justify high valuations. So none of that is around. We've got supportive macroeconomic policy. We've got the twin engines of easing monetary policy and supportive fiscal policy. So what that means is central banks are cutting rates and governments are spending, and those are good for the economy. The AI revolution, it is a genuine productivity boom. We used AI to create my wallpaper here in our virtual office, but it is much more than that. There's a huge amount of investment, real dollar investment happening in AI. This is the center of what could possibly be considered a bubble, because most of the market is not even close to this, but AI is dragging the market higher in terms of all these valuations that we are concerned about. But the AI revolution could sustainably drive costs materially lower and productivity materially higher. And we all see some of the amazing things that AI has done, and certainly we can imagine it going forward as it's deployed into companies and into the society at large, and things just getting way more productive, much like they did with the internet. In Canada, again, focusing at home, the market here is actually fairly valued, and it seems quite resilient. The TSX price earnings ratio is about 16. It's in line with its 10-year historical average. Estimates for earnings growth are still around 9%. That's healthy earnings growth for the market. So frankly, we just aren't seeing bubbly signs in Canada in terms of market valuations. The only thing that is concerning us is we do have trailing returns that are pretty high, and that usually begets some mean reversion. But that doesn't necessarily mean a crash, and it certainly doesn't mean a bubble. And then lastly, this is not 2008. We haven't seen systemic financial stability problems. We haven't seen anything that might even approach a negative debt cycle where you get defaults that are supporting equity values start to crash all over the place. Sure, we saw a little bit of fraud in the loan market in the US that came into the headlines recently, but that is a relatively small amount. And so far, we haven't seen that leak into other parts of the economy. So back to why is this not a bubble? Here's our charts against the argument. We spoke about margin debt being high and speculative excess, but margin debt relative to the overall market is actually quite low. In the top right here, just comparing Cisco and NVIDIA, Cisco from 2000 in the last speculative boom, you can see the price earnings of valuation of Cisco rose alongside its share price, whereas with NVIDIA, the valuation is staying roughly the same, which means it's actually profits that are driving NVIDIA's share price higher. So NVIDIA is growing at a huge pace. We don't know how sustainable that is. Of course, you got to look back to the last slide on how much capex is being spent, and NVIDIA is capturing a lot of that. But the speculative nature of a bubble implies that most participants will think that growth is going to go on forever, and therefore price earnings tend to increase. And we're not seeing that in the epicenter of the valuation here in the AI space. S&P 500 earnings growth, bottom left, it continues to be robust across most sectors. And of course, with Canada and EFI, which is developed ex North America markets, this is the price earnings ratio. You can see we're right along the lines of being pretty average. So we're not too worried about outside of the US about anything being speculative or excessive. What are our conclusions here? You'll notice that all the pro bubble arguments revolve around big tech and AI spend, and all the con bubble arguments are for the broader markets as a whole. So that leads us to believe that the speculative excess is somewhat contained. And what we worry about is that speculation and certainly all the spend around AI and all the money that has flowed to these mega cap companies that are doing the large amount of capex or receiving this huge capex around artificial intelligence, as that capex normalizes, that it will bring down the rest of the economy and the rest of the market with it. So we do remain cautious, and we have noted that in previous drawdowns, whether it be a correction like we had in March and April of 2025 or the bear market that we saw in 2022, those mega cap names suffered some pretty big drawdowns that frankly we would rather steer clear of. So our answer, as always, is to stay disciplined and diversified in our approach. There are parts of the cycle where that doesn't feel good to do, but over cycle, it definitely is always the answer. We'd also point out that diversifying by geography has become more important because we've seen some disintermediation of trade, to put it mildly, and some different investor flows as to where they want to put their dollars to work. So as always, diversification remains our answer. Risk management is always foremost for us to manage portfolios. And even though we are seeing some signs of speculative excess, we are comfortable to cautiously watch as this expansion cycle continues on. So thanks for joining me today. We will be back shortly with a 2026 outlook. We're going to pick some themes and some possible areas that are going to be of interest for 2026. And we will have, of course, a look back on the year that was 2025. We got 6 weeks left to go. So I hope everybody enjoys their November, and we will speak to everybody soon.